Hi, this is Ken Boyd from St. Louis Test Preparation. Here's our website, stltest.net. And as I scroll to the top, you'll see that we have links to all the books. And in addition, if you scroll down to the left, links to all the YouTube videos. In addition to that, accountinged.com is my think tank. Tremendous amount of information out here. You'll see as of May 2015, 22 hours of courses and much more to follow. And you can try it for free without using a credit card at accountinged.com. So what I wanted to talk about today was, I'm unfortunately, as I like to say, sadly, you can see these types of articles in any local newspaper of a decent sized city probably once a week. And in this case, we have a finance director from a city of Plymouth in Connecticut that was sentenced to 30 months in prison. I believe it's Connecticut. There's some information behind this as to how this happens, and the information supports a discussion, of segregation of duties. So let's go to a PowerPoint and let's talk about segregation of duties specifically. So there's three duties that whenever possible you need to keep separated between three people. Now, caveat there, if you have a small business, you may have to take on some of these tasks. That is more than one of these tasks with one person, but whenever possible, three different people should have these three different tasks, and we'll see why this is important in a minute. The first is custody of assets. That's the person who has the checkbook or the keys to the warehouse. That person should be person A. Authority to move the assets refers to who can sign a check to move money, who can take company equipment out of the warehouse. That person should be person B as in boy. And finally, record keeping. This is the person who posts accounting entries, reconciles the bank account. That person should be person C as in Charlie. So A, B, and C, three different people whenever possible. If you are not able to do this, you open yourself up to fraud and theft, which is what we saw happen in this article. Another point that's in the article is, what is the purpose of an audit? Well, if you look in the first paragraph of an audit opinion, what the auditor is saying is whether or not the financial statements are materially misstated, or said another way, are the financial statements materially correct? And material means relevant. Material means there's nothing in the financial statements that would cause a financial statement reader to change their opinion. That's what materiality means. That doesn't mean that everything's correct down to the penny. What the auditor is saying is that the financials are materially correct, not correct down to the penny. The problem that I had in this article, and you'll see it in a minute, that audits are not designed to find fraud, but I want to make a distinction. Audits are not designed to find fraud. Fraud is collusion, normally, between two or more people who are attempting to steal money from the company. And fraud also likely means that people have gone around or not followed the internal controls that a company has in place. Now, in today's world, 2015, auditors are required to make a judgment on the effectiveness of the company's internal controls. And if there's weaknesses, go back to the company, ask for explanations and changes, and also include that in information along with an audit report. Sarbanes-Oxley, or SOX, was passed after the Enron scandal in 2001, and also WorldCom, which has more stringent requirements on publicly traded companies, those that sell stock on exchanges to the general public, that there has to be a letter signed by the CEO and CFO that says, we assessed internal controls in the last 90 days. We didn't find any weaknesses. We've updated any changes that need to be made. So the internal control requirement has been ramped up after Sarbanes-Oxley because it was a lack of internal controls that caused the Enron scandal. I'd refer you to a great documentary called The Smartest Guys in the Room that is based on a book by a Wall Street Journal reporter about Enron, an amazing documentary. You'll be shocked at what you see in the documentary. That's an overview of some of the points made in this article. So what we see in the article is that this man was the finance director of the town of Plymouth. He stole $808,000. And if you scroll down, what exactly this person did was he wrote checks to himself from Plymouth, the city's accounts, and then simply deleted the entries from the accounting ledger. Well, here's the problem. He had custody of the checkbook. He had authority to sign the checks. It's implied here that he actually signed the checks. Now, somebody may have been signing them, but somebody else wouldn't be signing checks that are payable to him, I wouldn't think. So it's likely that he had authority to sign the checks and he had record keeping responsibilities because he was reconciling the bank account, it seems, because nobody else was catching it within the city. So he had all three of the duties that should be segregated. This is particularly damaging for a city because the city obviously has custody over public funds. And so there is broken trust, as they say here, between the city and the public. Here's how they caught him. A bank official contacted Merchant, who's the mayor, to report two suspicious checks that Berknagel, who stole the money, had written to himself on town accounts. So it was somebody at the bank who said, well, wait a minute. We know who the finance director is. Why is a check being made payable to the finance director? And it was just a smart bank official who actually found the fraud. What's important here to realize is the fraud was not found within the organization. It was found by somebody outside of the organization. So very sad. Now they make a comment down here about the accountants. Meyer was asked how the town's auditors failed to uncover the thefts, which were done through more than 200 checks, a lot of activity. And he talks about how they changed auditors. Now, I want to make the point again that while an audit is not designed to uncover fraud, because the finance director went around any internal controls that were in place, on the one hand. On the other hand, in today's world, auditors are asked to make a judgment on internal controls, and I think anyone with common sense who would have gone into the accounting department of the city and found that one person had custody of the checks, could sign checks, and also reconcile the bank account, there would be huge red flags. And just not knowing more, I'm surprised that the auditors did not find that glaring red flag. I don't know more about the story. But what we've learned here is what the three duties are that need to be segregated and also the purpose of an audit. That's as far as we'll get today. Remember, stltest.net, links to my dummies books and all the videos, and also accountinged.com, a think tank with a growing amount of training content for accountants, and you can try it for free here without any credit card. Try it for free for 3 days. Thanks very much for watching, and we'll see you next time.